Welcome to 10 Minutes About Oil. Today we are joined by Arne Lohmann Rasmussen, Chief Analyst and Head of Research at Global Risk Management. Welcome, Arne.
Thank you.
Nice to see you again here in Copenhagen. Hello.
It's always a pleasure.
Same here. We have several global factors that would usually be expected to push the oil prices up. We have the war in Ukraine, secondary sanctions on India for buying Russian oil. We have sanctions on Iran. Equity markets are near all-time heights and a weak US dollar. With all the factors that I just mentioned, we still have a weak oil price, trading in the mid to high 60s, down to some 10% this year. What is your take on that?
It's a good question. I think it has a lot to do with that the market is sort of forward-looking. It looks into especially Q4 and the winter, and what's going to happen in the winter. During the winter, we will probably have too much oil in the market. You remember that the OPEC Plus have added more oil, 2.2 million barrels a day. That's quite a bit of oil. Demand, actual demand, because one thing is geopolitics, but actual demand is not that high. It's not growing that rapidly.
Exactly. Yeah.
So if we ask, for example, the International Energy Agency, the U.S. Department of Energy, those heavy researchers that do a lot of forecasting and so on, they agree on that there will be a inventory build, basically an imbalance between supply and demand in Q4, and could be quite sizable. I think that is giving a downward push on oil
prices. Yeah.
And also, I guess, despite the geopolitics and the things you mentioned, and OPEC Plus have added more oil, they still have more spare capacity. So when you have these interruption in the flows, we all know that eventually the OPEC Plus could step in with more oil. I think that caps also the upside here.
To stay in the oil prices, right now the oil prices are relatively weak despite the global tensions. But what if we actually reached a peace agreement with Ukraine? What would happen with sanctions and prices then?
Yeah, that's another good question. We never know what has the market exactly priced in. I'm afraid, as we sit there today, that any peace agreement has not going to happen tomorrow, but maybe eventually, hopefully. Then you will price out some of this geopolitical risk premium, but it is a risk premium because do remember that the oil has been flowing all along from Russia. They have been able to sell oil in the world market, but if we get a peace agreement, I would expect a new sort of move lower in the oil price, maybe to the mid-low 60s.
Yeah, when we recorded the last video back in June, we discussed the strong market for high sulfur fuel oil, or 3.5%. What is the status today?
Yeah, that was quite remarkable back then, because the high sulfur fuel oil, which is basically this residual oil or leftover from the refinery process, was almost as expensive as Brent, even though this residual oil. It has cheapened. We look at this crack, the different, what is the price of 1 barrel of Brent, what is the price of 1 barrel of high sulfur fuel oil, or 3.5% bunker fuel. It is now around $6-7 per barrel cheaper, or if you calculate in metric per ton, it's around $40 cheaper per metric ton. So it has cheapened over the last, especially
significantly. Or
I would say that's a significant move in Brent. What is going on here? I think it is one reason is that we are moving away from the peak demand summer period. During the summer, there's a lot of demand in the Middle East from power producers to produce power for air conditioning, and they use high sulfur fuel for that, or fuel oil for that. So that has we're now focusing on more on the autumn and the winter, where demand will be weaker. The inventory situation is not as tight, especially in Singapore, that we have seen a build in inventories. So it's a combination of many factors. Maybe it is also that the market got a bit carried away, simply forgot that this is a residual oil. This should not be as expensive as Brent. So it's a correction in that. Maybe the market was also positioned wrong when it started weakening, then somewhere caught on the wrong foot. So, but we've seen a move now, but I think we are there where it's a more fundamental fair value we have now, seeing relative to Brent.
Yeah, thank you. What about the so-called distillates? Diesel, jet fuel, gas oil, marine gas oil.
The status is
Fusion.
we still have a relatively tight distillates market, especially the US inventories are low, to a certain degree also low here in Europe. There's a lot of focus on what will happen with the Russian production and export. Of course, there's a sanctions on that for Europe, but it's still shipped to Asia, Africa. Crude oil is shipped to India and China to be refined. We now have tougher sanctions on India. They face 50% in tariffs because they buy Russian oil. There's a ban coming here in the mid-January, where it's no longer legal to buy, for example, diesel or gas oil produced from Russian crude, mainly from India, but also from China. So I think there is a risk that especially these products will become more expensive relative to Brent. That is the so-called crack will widen again. It widened in January, now it's more, in June, now it's a bit more stable. I think there's an upside there, and that is certainly a risk one should be aware of if you're, a lot of our clients in that segment are on the buying side.
Exactly. Speaking of clients, how should our clients on the consumer side act to the outlook that you present, Arne? Where do you see prices in 2026 starting to look when we start to look for budget hedging in 2026?
Yeah, because that is
Why would they-
really coming up for a lot of our clients now. I think there could be some good entry levels for those of
Yeah.
our clients that are on the sort of buying side, consumers, that they could hedge next year. A lot of analysts have been calling for lower prices also today. It hasn't really materialized. It's been relatively stable as we discussed. Prices may come under pressure during the winter, this inventory build, but we also have to remember there are some mitigating factors. I don't think there'll be a peace agreement in Ukraine. We're now at a price level for Brent, where, for example, the US production is being impacted. So I would not recommend clients to say, okay, we will not hedge anything. We will have a very low hedge ratio. I think one should stick to the sort of more or less benchmark they have, and not a high hedge ratio, but also not a low benchmark. A normal benchmark hedge rate. There's also a bit of what you call backwardation in the curve. There's actually slightly lower price, not much, but there's a bit lower prices if you buy oil and oil products in the future compared to where you buy in the spot. I also believe if we move much lower, OPEC might actually start taking oil away from the market again. So I think 65 in Brent is a very strong support level. And definitely, if we see a dip to, let's say, 60, I would think that it's an excellent entry level to hedge some exposure for next year and for the winter and for Q1, depending on what horizon our clients are looking at. So, but overall, a hedge ratio along the lines of benchmark.
Thank you. Very nice said for our clients out there. That's all that we had time for today. Thank you very much for seeing me here in Copenhagen. Hello, always a pleasure to have you here, Arne, and see you again next time. Thank you very much.